Welcome to Delphos Insights. Today we're tackling a really fascinating paradox in global finance. How do you invest hundreds of millions of dollars in some of the world's most dynamic and, let's be honest, riskiest markets, and still come out with bankable returns?
That's the core question. And we're going on a deep dive into 4 decades of structured finance history to find the answer.
We're drawing on a huge amount of experience here.
We are. The mission is really to understand the evolution of this discipline, and we're pulling insights from over 600 successful financial transactions in what we call emerging and frontier markets.
So we're talking about how expertise can be used to, I guess, engineer confidence.
That's the perfect way to put it. Engineering confidence where it otherwise wouldn't exist.
Because when most people hear emerging markets, their minds immediately jump to all the negatives, political risk, currency collapse, that sort of thing.
They see the risk first, and that focus can make you miss the sheer size of the opportunity.
And the opportunity right now is compelling.
It's very measurable. If you look at the yields as of, say, March 2025, the hard currency EM sovereign bonds are offering something like 7.8%.
And if you go even further out on the risk spectrum,
Into frontier market sovereigns, that yield climbs to about 8.6%.
so that's more than double the return of a 10-year U.S. Treasury, which is sitting around 4.0% right now.
Exactly. And that massive spread is the engine driving all of this. But as you said, the reward only matters if you can manage the downside.
Right, and that gets us to the core thesis of this whole history.
Absolutely.
Yeah.
The leaders in this field have been saying it for years. Risk is not avoided. It is engineered, mitigated, and structured.
That one statement completely changes the frame, doesn't it? We're moving beyond just buying insurance.
Way beyond that, we're talking about complex structural architecture. It's a synthesis of structured finance, political risk insurance, we'll just call it PRI guarantees, blended finance, and now even AI-driven analytics.
So for you, the investor, the lender, or the developer listening, understanding this toolkit isn't just nice to have.
It's essential. It's how you capitalize on these markets without getting wiped out by the volatility. The metric that truly matters here isn't the raw return.
It's the risk-adjusted return.
That's the whole game, turning high potential into dependable performance.
Okay, let's unpack this evolution. To really appreciate today's toolkit, we have to go back. Put us in the shoes of a banker in the mid-1980s. What was so challenging?
It was finance on hard mode. The challenges were immense. You had extreme currency volatility, capital markets with almost no liquidity for long-term projects, and of course, regulatory and sovereign instability.
And just a real scarcity of reliable data to even begin your analysis.
A huge scarcity. So you might have a perfectly viable project, say a new power plant, but a commercial bank just wasn't willing to extend a 15-year loan.
Because the government might change the rules overnight or even nationalize the asset.
Precisely. That long tenor risk, as we call it, was just too much for the private sector to bear alone, and that's where the power of partnership first came in.
We're talking about an institutional backbone here.
Yes, the first structures really relied on public support. Development finance institutions, DFIs, and export credit agencies, or ECAs, their main job is development and stability, not just profit.
So they formed the safety net.
They did. They offered the PRI, the guarantees, and the long tenor debt that allowed those early investments to happen.
It's hard to imagine getting high-tech exports into these markets 3 decades ago. Let's talk about some of those early deals.
A great example is Impact Systems in 1990. They were expanding telecom infrastructure in the Middle East.
And commercial financing wasn't available for that risk.
Not at all. They secured guaranteed loans, about $6 million, plus another $2 million in guarantees, and that made the entire project viable.
We see this pattern in other advanced sectors, too.
We do. In 1989, Semiconductor Test Solutions got a $2 million guaranteed loan for a high-tech export. And in 91, Biogenix Laboratories used a $1 million loan to get biotechnology into Asia.
So these weren't just commodities. This was about supporting the global expansion of critical technology.
Exactly. And maybe the earliest masterclass in managing this layered risk was the Ormat geothermal deal in El Salvador in 1992.
That was a huge one, a $72.4 million guarantee through the U.S. Exim Bank.
That Ormat deal is a textbook case. El Salvador at the time was defined by heavy political and foreign exchange risk.
So how did the structure protect the deal?
It was designed to ring-fence the revenue stream. It essentially converted a volatile local currency promise from the power purchaser into a hard currency guaranteed payment for the U.S. supplier.
So it shielded them from both major risks at once.
Simultaneously, It proved that these guarantee structures were the crucial mechanism for enabling projects where the private market just couldn't go alone.
And that proof of concept must have paved the way for more private capital to follow.
It did. As we move into the mid-90s and 2000s, private money starts flowing in, and that forces the toolkit itself to evolve.
This is when the modern guarantee market really starts taking shape.
The focus shifts from just using off-the-shelf products to actively designing complex credit structures. We start seeing tools that are standard practice now.
Things like partial risk guarantees, first loss layers.
Accounts receivable facilities, insured credit lines, and those really sophisticated, multi-layered, blended finance stacks.
Okay, let's break some of that down. That terminology can be a bit dense. What makes a first loss layer so important for de-risking a project?
Think of it like a deductible. It's the first slice of potential loss, maybe 5 or 10%, that a specific investor or the project sponsor agrees to absorb.
So they take the first hit if something goes wrong.
They take the first hit. And by absorbing that most volatile piece of the risk, the remaining 90% of the debt becomes fundamentally safer. It becomes much more attractive to conservative lenders like commercial banks.
And what about the multi-layered blended finance stack?
That's the epitome of collaboration. You're combining different kinds of capital. You might have public development funds, guarantees from DFIs, and private commercial money all stacked together.
So each layer is protecting the one beneath it.
It's like building a financial shield. The structure is specifically designed to withstand the volatility of these markets.
So the expertise shifted. It wasn't just about using existing insurance. It was about engineering new applications of PRI for specific needs.
Precisely. You see this supporting critical infrastructure everywhere. Take Sunrise Technologies in 1994, with insurance structured for telecom solutions across the Americas.
Or New World Parking in 95, using PRI for infrastructure in Europe.
It's the difference between buying a standard fire extinguisher and designing a custom fire suppression system for a specific building, considering all its unique hazards.
And it's important to remember, this isn't just about protecting the investor.
That's a key point. These tools stabilize cash flows for the project, which in turn enhances the host country's financial resilience.
Collaboration with multilateral banks must have been crucial for scaling this up.
Absolutely. A perfect example is the Eurotel Slovakia project back in 2000. It was a $45 million project to upgrade a mobile network.
And it had backing from both the IFC and MIGA.
Yes. MIGA, the Multilateral Investment Guarantee Agency, provides the political risk insurance, and the IFC, the private sector arm of the World Bank, provides financing. Their combined backing made a complex project viable, and it ultimately served over 150,000 subscribers.
We see a more recent example with the BTS Towers deal in Latin America in 2018.
Right, the first OPIC financing for telecom towers in the region. And OPIC is now the DFC, the U.S. Development Finance Corporation.
So these transactions weren't just building towers, they were building a viable model for how to finance that kind of infrastructure.
Exactly. And you can see the results in the data. MIGA issued guarantees have scaled dramatically. They went from $2.8 billion in 2015 to an expected $9.5 billion in 2025. The market for mitigating risk is growing right alongside the opportunity.
Let's pivot to some case studies that really show this transformational change in action. We should start with the long-term play in geothermal power in Central America.
The geothermal story is a perfect example of how you establish an entire sector. It really began with that Ormat deal in El Salvador in '92.
And that success was followed up quickly.
Immediately. In 1998, there was a major debt and equity raise in Guatemala for $65 million, and it was backed by MIGA.
And what's so unique about those early geothermal deals is the layers of risk. It wasn't just political and currency risk.
No, you also had the geological risk of drilling, and in that region, significant risk from natural disasters. The structural innovation was absolutely key.
And the outcome.
These deals established geothermal as a truly bankable sector in developing markets, long before climate finance became a mainstream idea. They directly supported GDP growth and reduced reliance on imported fossil fuels.
Now, shifting to digital innovation, the telecom deals are just as important for creating financing models.
They are. Deals like ADC Telecommunications in 2000 and Nutuk Kakam in 2005 involved large guaranteed loans that supported massive infrastructure expansion.
And a crucial detail there was the use of local currency financing whenever possible.
Absolutely. Structuring debt in the same currency that the project earns its revenue in, while using guarantees to protect the hard currency portion, like imported equipment, created much more resilient projects.
So the outcome there is that these deals created the blueprints that are still used today for digital infrastructure rollouts. They literally connected these markets to the global economy.
They did. And that brings us to the next frontier. We need to look at what the most recent transactions tell us about where this is all heading.
Specifically in areas like fintech and critical minerals. The Maxachili deal from 2024 seems to point the way.
It does. It was a $7 million facility for a fintech that supports over 40,000 small businesses. This is where data-driven underwriting really takes center stage.
Because these fintechs have access to so much data that traditional banks just don't?
Exactly. They can use predictive analytics to underwrite loans more accurately, and then use insurance to enhance the credit quality of that whole portfolio. It drives huge financial inclusion for the small businesses that are the lifeblood of these economies.
And if we connect that idea to critical mineral supply chains, the need for these robust, specialized structures becomes even clearer.
Indeed. Critical minerals are essential for the energy transition, but their supply chains often run through very politically sensitive markets. You need specialized guarantees and PRI to safeguard those massive long-term investments against things like expropriation. It's becoming vital for global economic stability.
So, after reviewing nearly 4 decades and 600 transactions, what are the big, enduring lessons here for anyone trying to navigate these markets?
I think we can distill it down to 5 core principles. First, this is the most important. Volatility is a constant. The nature of the risk changes, from currency risk in the 90s to geopolitical and climate risk today, so you have to be adaptable.
Which leads to the second lesson, which is that you can't just rely on spreadsheets.
No. Local knowledge is irreplaceable. Data analytics are powerful, but they are no substitute for deep, on-the-ground intelligence. That local context is what makes a deal truly bankable.
Third, and this ties back to that engineering philosophy we talked about.
Customization beats templates. The most effective solutions are designed for the specific realities of an individual project. A generic structure will eventually fail.
And fourth, something that was true in the 80s and is still true today.
Partnerships are paramount. Success always relies on strong alliances between the public sector DFIs, ECAs, and the private sector to share and mitigate risk effectively.
And finally,
institutional memory creates advantage. Decades of experience create a powerful pattern recognition capability. It allows experts to anticipate challenges and structure deals that others would see as too risky.
And now we're seeing technology come in and amplify all 5 of those lessons.
Exactly. The future isn't about replacing human expertise. It's about giving that expertise more powerful tools.
So we're talking about AI-driven risk scoring, predictive analytics for instability.
Even smart contracts that could automate PRI claims and guarantee triggers, adding speed and transparency to the whole process.
So technology will significantly amplify human expertise. That's the final synthesis, really. Across all these projects, success becomes investable at that critical point where local realities meet global specialized expertise.
Absolutely. So given the massive scale and complex opportunities we've seen, what structure, whether it's AI-enhanced blended finance or customized guarantees for critical supply chains, do you think will be the most essential tool for unlocking sustainable development in the next decade of emerging market growth? This has been Delphos Insights. Learn more at delphos.co.